Alright, hi guys, welcome to this webinar. I'm Adam Koo and we're going to focus on how do you build a profitable trading business in the next couple of hours in the Forex markets. So I believe you're listening to this because you want to create another source of income for yourself that's recession proof, you can do it from anywhere in the world, or you've got savings and you grow your savings at a much higher return. You're going to learn exactly how to do it in this webinar. And the first thing is, I refer to Forex trading as a business because it's like any other business. If you always want to be an entrepreneur, to run your own business, Forex is one of the best businesses to be in. And if you think about it, in any business, how do you profit? You buy something at a lower price and you sell it at a higher price, right? Or you sell it at a higher price and you then buy it at a lower price to deliver the goods. So for example, if you own a shop, you're buying clothes at a lower price and selling at a higher price. You own a restaurant, you're buying ingredients at a lower price and selling at a higher price. So there's no difference in the Forex trading business, except you're buying and selling currencies. Now that sounds a bit complicated to some people, but it's actually really simple once you learn this. And anyone can do it with the right kind of training. So let me begin by introducing myself and telling you a bit about my background. I started trading when I was 17 years old. I started in the stock markets and I still invest and trade in the stock markets heavily. And I also trade in the Forex markets. So I started at 17 years old. I'm now 44 years old. So it's been the last 27 years I've been in the markets. And 12 years ago, I started a school that's now one of the biggest financial training institutes in Asia. It's called Wealth Academy. So if you ever want to hop on a plane to come to Asia, in Singapore, Malaysia, or Vietnam, I run my live courses in Asia. We now train thousands of students all around Asia. Many of my students today are able to grow their wealth and income way beyond what any managed funds can do for them. A couple of my students are also full-time professional traders and they're doing this for a living. And kind of recently, about a year ago, I created the Piranha Profits online trading course for people who are far away. I now have many students in the US, in the UK, in South Africa, all around the world, and they can't come to Singapore. It's too far for some of them. So we've got Piranha Profits that teaches all these skills and techniques through my online video training course. So today I'm going to share with you how you can get started in the Forex business and how it can be a very lucrative source of income for yourself to achieve really consistent profits in the years to come. Now, I can see from the survey, some of you have never traded Forex before, and some of you have been trading for a few years, but you're struggling to become profitable. So wherever you are right now, I'm going to start from the basics and work my way up with you guys to the more advanced stuff. All right, so if you have traded Forex before, forgive me as I go through some of the basics for our listeners who have no idea what Forex is. Okay, like I said, it sounds complicated. It's actually pretty simple once you learn this. So Forex stands for foreign exchange. Okay, and it's a market in which one nation's currency is traded for another nation's currency at a mutually agreed rate. Now, the Forex market is run electronically within a network of banks, and it's run 24 hours a day, 5 days a week. So that's the beautiful thing about it. You can trade whenever you're free, before or after your daytime job. So you can keep your daytime job and trade Forex as a sideline business that just takes a couple of hours a day, and you can have another stream of income. Now, it's the largest market in the world. The Forex market is 3 trillion per day compared to the stock market of 500 billion a day. Okay, so it's the biggest market and you can get in and out very easily. It's known as a very liquid market. Okay. Now, like I said, trading Forex, the only way to be successful is to look at it as a business and not just a hobby, not something when you're free you look at it, right? It's going to be like a business that you take seriously. And I mentioned that it's one of the best businesses to be in for a few reasons. Number one, Forex takes minimal investment to get started. You can start with as little as $200 to open an account. But if you start any other business, you need a few $100,000 to get a shop front and hire staff and get inventories, right? With Forex, you can start with very little. Next, minimal time commitments. In most businesses, you spend 12 to 16 hour days, especially if a startup business. You've got no life, you're doing everything. In the Forex business, you can get really good results by just dedicating anywhere from 3 to 5 hours a day, or even less if you want to as well. There are no employees to worry about. There's no office space needed. You can do it from your house, from your bed, on the beach, and you don't hold any kind of inventory. And the best part about Forex is that it is recession proof. So whether we are going through a financial crisis, whether the market's booming, it makes no difference to us because we profit regardless of the currency direction. We can go long and we can go short. And I'll explain what that means in a short while. Okay, that rhymes, okay. But important thing is like anything else, okay, to succeed in the Forex trading business, you must be willing to work hard. I keep telling people that Forex is not a get-rich-quick scheme. There's no such thing as a get-rich-quick method in the world. There's no such thing. So if someone tells you they can get rich overnight with no risk, you better run away because there's no such thing. Okay, Forex trading is like any other business. There is risk if you don't know what you're doing. If you don't work hard, you can lose money in the business. But if you're willing to work hard and learn the right strategies and follow the rules of business, in Forex trading is extremely low risk if you know what you're doing. And like any other skill, it's like being a doctor or lawyer, it takes a certain set of professional skills. The good news is that it takes less time to master the skill compared to being a doctor that takes 7 years or a lawyer that takes 6 years. Nonetheless, it still takes professional skills nonetheless. So you must be willing to work hard at this. Okay, if you're just here to spend a few minutes a day and hoping that it's going to make millions of dollars, I'm sorry, you're in the wrong place. There's no such thing. And the trouble with most people is that they enter trading and they behave like a gambler, right? So they depend on luck to make money. And sure, some people can make a lot of money just by luck. But guess what? Luck doesn't last forever. And 99% of the time, these people who make all their money from luck with no skills, just betting big on the price, eventually they will lose everything. It always happens. Okay? In a short term, you can get lucky in trading. Because in trading, there are only two things you can do. You either buy or sell, right? That sounds simple enough. And that's why some people just get it right just out of luck. But you know what? Making money is really simple in trading, but to make money consistently is really challenging. It's really tough without the right skills. So I'm not going to show you here just how to make a lot of money one time because you're going to lose it easily like most people do. I'm going to show you how to do it consistently month after month, year after year, so it becomes a sustainable business and income source for you. And if you're interested in that, you know what? I'm going to make that happen for you. All right, guys? Now, like I said, it's a 24-hour market, so it's very flexible. You can build your trading business around your day job and again, from anywhere in the world, as long as you got internet connection. So North Korea could be a problem, okay? All right, next. Generating constant profits, okay? If you start, most businesses, you may take a few months or years to break even, or not even break even at all. But in a Forex business, you can start making profits from the first month if you use the techniques properly. And profit returns of 5 to 25% a month are very possible, okay? So in other words, if you've got a $100,000 account, to make 5 to 25,000 a month on average is very, very normal, okay? Now, I know some of you are saying, Adam, I've heard of people making 100% a day, 1,000% a month. Why are you only telling me 5 to 25% a month? Well, here's the reason why. People who make 100% a day or 1,000% a month, it's because they are risking too much. Okay, these guys are bloody gamblers. And yeah, you can get it right. There are people who do. But they don't tell you that the next month they lose everything and a whole lot more. And that's not what I want for you or for myself. I want to make consistent profits with low risk. And to do that, we're just looking at, again, 5, 15, 20, 25% a month. But if you do that consistently, your money will compound at a huge rate. Okay, and it's still better than any other business out there. So please don't think of hitting home runs every day. Okay, think of taking small amounts of the money out of the market consistently, so that it's sustainable. All right, guys, that's the most important thing. Now, so as you can see that around the clock, the Forex markets are trading through different banks around the world. So you start with the Sydney Australian market that starts at 6 a.m. Now, this is my Singapore local time. So if you're in New York, Eastern Standard Time, 6 a.m. would be 6 p.m. in New York, all right? And 9 p.m., my local time would be 9 a.m. New York. Now, you don't really have to worry about the time or which markets are trading because I take the trade setups when they come. Okay, so I get trade alerts, and you'll be getting these trade alerts as our students will send you the alerts. They will alert you, hey, there's a potential trade. And these trades can come anytime. It could be in the morning, in the afternoon, in the evening. And sure, there are some times when you're busy, you're working, you can't take those trades, and that's fine. You only take those trades during times when you're free, and that's good enough. So all I'm here to tell you is that trade alerts and trade setups can come anytime during the day because it's a 24-hour market. So here are some basics. Now, whenever you look at a price of a currency, it's always quoted in a pair. And they're altogether 8 common currency symbols. You've got the euro, EUR, the US dollar, the British pound, the Japanese yen, the Swiss franc, the Aussie dollar, the Canadian dollar, and the New Zealand dollar. So just kind of like get familiar with these symbols over here. Pretty simple to remember it actually, yeah? Now, you have got all kinds of pairs. So you can have the Euro USD pair, you can have the US dollar yen pair, you can have the pound franc pair. So you got all these different combinations. Now, I trade all the combinations. I trade the common 7 liquid pairs and also the cross pairs. Okay, so I trade any pair. The only thing I don't trade is I do not trade the exotic currency. So I don't trade like the Hong Kong dollar, the Singapore dollar, or the Zimbabwe dollar. Okay, I only trade the 8 major symbols and all their pairs. Okay, because they're all profitable. Okay, how do you read a currency quote? So currencies are quoted in pairs, like I mentioned, and always in 4 decimal places for the non-yen pairs. So anytime you've got a pair that doesn't have a Japanese yen, the JPY, there's no JPY, it's always 4 decimal places. So for example, the Euro USD, okay, this is a pair. Okay, we call it the Euro dollar. Now, the first currency in the pair is known as the base currency, and it's normally the stronger one. Okay, the second one is known as the quote currency. Now, the base currency is always 1. It's always 1. Okay, so when you see Euro USD is 1.3505, what does it mean? It means that 1 euro equals to 1.3505 US dollars. So in other words, 1 euro is equivalent to 1.3505 US dollars at this point in time. So if you want to buy 1 euro, you have to pay 1.3505 US dollars. Similarly, if you want to sell 1 euro, you receive 1.3505 US dollars. Okay? Now, like I mentioned, it's quoted in 4 decimal places. Okay? Mainly 4 decimal places. And the last decimal place, the 4th decimal place, is known as a pip. All right? So we're talking a lot about pips. So for example, if it goes from 3505 to 3506, what does it mean? That means the euro went up by 1 pip against the US dollar. Got it? If it goes from 3505 to 3504, the euro went down by 1 pip against the US dollar. So 1 pip is the 4th decimal place in a currency pair. Now we say, hey, isn't there a 5th decimal place? Yeah, that's known as the fractional pip. But most of the time, we'll be calculating in pips. All right? Now, and then you've got the yen pairs. Now, the yen pairs are a bit troublesome because they are quoted in 2 decimal places. So every time you've got a yen pair, like the dollar yen, the pound yen, the euro yen, every time there's a JPY, you see 2 decimal places. So whenever you see 2 decimal places, the 2nd decimal place will be the pip. So again, if it goes from 9873 to 9874, what does it mean? It means the US dollar increased by 1 pip against the yen. And if it goes from 9873 to 9872, what does it mean? The dollar went down by 1 pip against the yen. Okay, so that's how you read it. And again, the third decimal place for a yen pair is known as the fractional pip. Okay, so do you remember what is the first currency called in a pair? It is called the base currency. Remember that? It's called the base currency. Oops, sorry. It's called the base currency. And again, the base currency is always 1. And this is known as the quote currency, which is always what you see there, right? So 1 US dollar is equal to 98.73 yen. Okay, so that's how you read it, basically. So again, if you want to know what pip means, it's price interest point. It's the smallest change in value for any Forex quote. And again, it's a fractional pip as well. So far, are we okay? Do you understand? Can you follow? Okay. So now we're going through the basics to just get a foundation, all right? Now, when you purchase currency pairs, we calculate in terms of lot sizes, okay? Especially if you're trading with the MT4 or MT5 platform. That's the most common trading platform that Forex traders use. So I use an MT4 platform myself. So when you want to put in how many, how much you want to buy or sell, you put in lots. So if you put in 1, that means 1 lot. Okay, so what's 1 lot? 1 lot is 100,000 of the base currency. So if you're trading Euro USD and you key in 1, that means you're buying 100,000 euros worth of the currency pair. Again, if you're selling the Aussie dollar, you click sell 1, you're selling 1 lot, which is 100,000 Aussie dollars. Got it? Okay, good. Now, so again, those pairs that are non-yen, notice that again, we calculate it to the 4th decimal place. So 1 pip is the 4th decimal place. For the yen pairs, it is to the 2nd decimal place. Now, some of you could be thinking, are you saying that the minimum I must buy is 1 lot? No, you don't have to buy 1 lot. You can buy 0.1 lot. You can buy 0.01 lot or 0.001 lot. Okay, so yeah, I mean, that's a very small minimum, so no worries about that. Okay, so if you buy 0.1 lot, what does it mean? 0.1 means you're buying 10,000 euros. Okay, now you may say, I don't have 10,000 euros. Okay, now in Forex, what happens is you don't actually need 100,000 euros to buy 100,000 euros. You don't need 10,000 euros to buy 10,000 euros because Forex brokers, they give you leverage. And what leverage means is that to buy 100,000 euros, for example, all you need is 1,000 euros. So we call that 1:100 leverage. In other words, for every $100 you buy, you only need $1 of cash in your account to buy that. So that allows you to use little money to buy big amounts of currency. So a small movement in the currency would mean a big return on your capital. So that's what we know as leverage, and that leverages your returns. Let me say, okay, so how many lots should I buy? How much should I buy? So that all depends on your risk per trade, and with the risk per trade and your capital, you calculate your position size, the number of lots you're buying. And I'll show you exactly how to calculate that in a while. So it's based on mathematics, not based on feelings, all right? Okay, so coming to the exciting part. How do you calculate your profits in the Forex markets? How do you know how much money you made? So in Forex, we always talk about earning pips, right? We want to make pips, make pips, okay? So your profit would be equals to the number of pips that you earned multiplied by the number of lots, right? So again, 1 lot or 2 lots or 0.1 lots. Again, 1 lot means 100,000 of the base currency, remember that? Okay, multiply that by the dollar value per pip per standard lot. So in other words, what is the dollar value per pip? So every pip, how much do you earn per lot? Okay, now roughly it's about $10. It's about that, right? So most pairs that have the US dollar, like the Euro USD or the dollar yen, every pip that moves, you make $10 for every one lot that you buy. Now, if you want to know the exact pip value, you can go to many websites. This is just one of the websites that you can see. This is the pip value based on 0.1 lot. Based on 0.1 lot. So in order to get one lot, multiply the values by 10. So if you multiply this by 10, what do you get? You get $10. Right? You get $10. So you can see that for these pairs, which are the US dollar pairs, okay, every one pip movement is $10, which I just mentioned, okay? But these are some of the other pairs, like the dollar yen, the dollar franc, the dollar cat. It's not exactly $10. Like, for example, this would be $9.50 because you multiply by 10, $9.50. And this would be multiplied by 10, it'd be $1. Okay, we're not trading Hong Kong dollars, so forget about that. Dollar Canadian, that's multiplied by 10 is $7.80. So if you're trading the dollar Canadian pair, every one pip movement, you're earning $7.80 per one standard lot. Okay. Now you don't have to remember all this. Don't worry about it. Okay, because all you got to do is to use the Forex calculator, where all this is calculated automatically for you, right? So you don't have to know all this stuff. This is just for general knowledge, right? So with the calculator, I'm going to show you that with the calculator, you know exactly how many lots to buy, what's your risk per trade, and what's your potential profit per trade, okay? So no worries about that. Okay, so let's look at a few examples, right? So in this example, we're looking at the Euro USD pair. Let me zoom that in, Euro USD pair. And you can see that this pair is on an uptrend, right? The price is moving up. So if you think that you continue going up, you are bullish. Bullish means you think it will go up. That's what bullish means, okay? So if you want to make money, what do? You buy at the low price and you sell at a high price. And we call that going long, right? It's called going long. So in this case, we are going to go long on the Euro US dollar. So assuming that at this point of time here, you decided to go long, right? To buy and then to sell in the future. So you buy the Euro USD pair at 1.2285, for example. Now, a couple of hours later, you can see that the price went up as you anticipated to 1.2405, and you decide to sell, right? So you buy and you sell like anything else. So how many pips did you make? 2405 minus 2285, you make 120 pips. All right, you capture 120 pips. So how much is one pip? Like I mentioned, one pip is $10, right? On average, $10, okay? Per lot. So how many lots do you trade? So assuming if you trade one lot, you buy one lot, okay, your total profits would be $1,200. Ta-da! You made $1,200, right? Now, how much cash would you require in order to buy this? Again, remember that one lot is 100,000 euros, but again, you don't need 100,000 euros. So if you use a leverage of 1:100, for example, then all you need is 1,000 euros in your account in order to make this happen. So with 1,000 euros, you make $1,200. All right, so there's a 100% return in just a couple of hours. Now, I'm not saying that you should use 100-to-1 leverage. I'm not saying that. I'm just showing you an example. Later, I'll tell you exactly how to calculate the number of lots to trade so that it's really low risk and it's high return. Okay, so hang on for that. Okay, besides going up, a currency pair can go down. So in this case, once again, the Euro USD is going down. It's on a downtrend. So imagine at this point of time, over here, you believe that it's going to keep going down. So you are bearish, right? Bearish means you think it's going to go down. So what you do, if you want to make money, you have to sell high and buy low. You do the complete opposite. And that's called going short. Going short, right? So at this place, we decide to go short, which means we decide to sell. And we're going to sell the Euro USD for 2410. Okay? And sure enough, the price goes down as we anticipate. We're happy. We buy low. All right? So it's the opposite. Initially, it was buy, sell. Now we sell and buy. It's just the complete opposite. So you sell at 2410 and you buy at 2319. What's the difference? The difference would be 2410 minus 2319 and you get 91 pips. So in this case, again, you gain 91 pips. And each pip is, drum roll, about 10 bucks on average, right? And again, if you buy one lot, that's $910. So it means $910 out of one lot. So again, one lot is 100,000 of the base currency. And again, you don't actually need 100,000. With leverage, if you have 1,000 euros, you could buy this pair for one lot, and basically you put in 1,000 euros to make $900. All right, which is again almost 100% return in just a few hours. Okay, so again, how many lots do you trade? Now back to that question: how many lots do you trade? So before I show you how to calculate your position size, I want you to understand. So notice that when the price went up, we bought low and we sold high. We went long for profits. When the price went down, we sold high and we bought low. We went short for profits. So in other words, there's no such thing as a good or bad currency market. There's no such thing, right? Because if it goes up, it's good if we go long. If it goes down, it's good if we go short. And there's no good or bad currency pair. So we profit as long as we follow the direction of the currency pair. And this is what makes this business recession-proof. Okay, we do not depend on the external world for our results. It depends on reading and following the trend. Now, million-dollar question is, how do you determine the direction of the currency pair? Right? How do you know where the price is going? All right? Can we predict the future? Of course we can't. We can't predict with certainty where the price will go, but there are ways that we can find with the highest probability where the price is likely to go. And we can't get it right all the time. But we don't have to get it right all the time. We just have to get it right a bit more than we get it wrong in order to make huge profits in the markets. Okay? In order to determine the direction of the currency price, we use technical analysis. Now, technical analysis is a study of emotional patterns that are captured on price charts. Remember, what drives the price up and down every day? It's demand and supply, right? When there's more demand than supply, price goes up. There's more supply than demand, price goes down. So what drives demand and supply? Emotions, okay? In times of fear, people sell, the price goes down. In times of optimism and greed, they buy and the price goes up. So it is emotions that drive prices up and down every single day. So by studying chart patterns, we can read the emotions driving the price, and we can anticipate how the price would likely behave. And what we look for are repeatable patterns, because human beings behave in a very consistent manner in history, right? When we get scared, we sell. We get excited, we buy. And these emotional patterns are reflected on the charts. So we can then use these repeatable patterns to understand collective human psychology in order to make money in the markets. So what techniques do we use in order to read these patterns? These are the patterns or the tools which I use that are really, really powerful and really reliable. The first thing is to understand the power of the trend. Okay? A trend is like a river current. When a river is flowing on an up current, guess what? The water tends to go up. When the river is on a down current, the water tends to go down. And if you just row your boat with the current of the river, okay, that makes trading very easy because you follow the current, the price, okay? So the first thing is you have to determine where is the trend of the market. So for example, you can see markets move in cycles. They move in different trends. So over here, you can see the price is on an uptrend pattern. It's an uptrend pattern. So anytime you buy over here, the probability is that the prices will go higher and higher and higher. So you want to go long on an uptrend pattern. And over here, you have got what we call a consolidation pattern where the price moves sideways. And then over here, again, it goes into another sideways pattern. And over here, it goes onto a downtrend pattern. And again, over here, it goes into another sideways pattern. And then an uptrend pattern. So it goes into these different cycles, okay? So one of the most important things that you must do as a trader is to know which trend are you in right now. Are you in a sideways trend? Are you on an uptrend? Are you on a downtrend? And I'll show you a simple technique to read the trends very accurately. And as long as you buy with the uptrend and sell the downtrend, the odds are in your favor, where the price will likely move in that direction. Not 100% of the time, but very, very often. And it's as simple as that. Next, we use candlestick patterns. So the prices are made of candlesticks, and based on the shape of the candle, it tells us the emotions driving the price at that moment. And I use a lot of candlestick patterns in my trading. I hardly use indicators in Forex trading. I use a lot of price action and candlestick patterns to time my entries. And you're going to learn exactly how to do that in the Forex trading course. Next, very important, is known as supply and demand zones, or we call it support and resistance. This tells you where sellers and buyers are queuing up and where price is likely to reverse. So sometimes you see the price going up, boom, comes down. Goes up, comes down. What's causing that reversal is a supply level. Many sellers are waiting to sell. Many times the price goes down and it reverses up when it hits a certain level that's known as a support level. That's what we call demand zone, all right? So you've got to know this stuff, very, very important, right? Next, moving averages. I use a lot of moving averages to determine the direction of the trend and to determine whether the price is overbought or oversold. Next, multiple time frame alignment. This is one of the most important things in trading. Now, some people ask me, Adam, which time frame do you trade? You trade the 5-minute candles, 15-minute candles, 1-hour candles. I personally love to trade the 15-minute candles. That's my favorite time frame. But there is no right or wrong time frame. You can make money in any time frame. But here's the secret. If you're trading the 15-minute time frame like I am, you always have to look at one higher time frame to confirm the trend. So in my case, when I'm trading the 15-minute time frame, I always double check the hourly time frame. Similarly, if you trade the daily time frame, you have to check the weekly time frame to confirm the trend alignment. It's one of the most important things is multiple time frame alignment. So using all these tools, we're able to anticipate with probability, high probability, where is the price moving in the short term. And as long as we go on for the ride, we are going to make money. All right? So I just talked about this, the market cycle, right? So basically there are three main patterns. You've got the uptrend pattern, like so. Again, that's the uptrend. That's the consolidation, going sideways. You have got the downtrend over there. You got another consolidation over there. And you have got the uptrend over there. You have to read the trend you're in right now. One of the most important things, all right? Now I've got questions coming in, so no worries. I'll answer all your questions by the end of the webinar. I'll probably answer most of the questions at the end of the webinar. So yeah, keep your questions coming. I am reading them, I am looking at them, and I will answer your questions. So don't worry about it, guys. Okay. Okay. So the first thing, like I said, the most important thing is to determine what is the trend of the market right now. Okay, and again, depends on the time frame. So again, for me, I'm looking more at the 15-minute time frame and the hourly time frame. Now, the first trend is known as an uptrend pattern. So on an uptrend, do prices still go down? Yes, they do. But every time the price goes down, guess what? It goes higher and makes a new higher high. Every time the price goes down, it makes a new higher high. Price goes down, makes a new higher high. So an uptrend is defined as higher highs, right? The price makes higher highs. And every time the price goes down during a dip or correction, it makes a higher low than the previous low. Higher low than the previous low. Okay? So an uptrend is defined as a series of higher highs and higher lows. That's something that you got to know. All right? Now, on an uptrend, why is it so important? Because on an uptrend, the statistical probability is that prices will move higher. So you never want to sell on an uptrend unless you're suicidal. Okay? You only want to buy on an uptrend. You only want to go long on an uptrend. And if you just keep doing that, the odds are in your favor. It's like tossing a coin with a buyer's head. You will make money most of the time if you just buy on the uptrend. But again, you must also know which part of the uptrend to buy, right? So let's take a look at this chart. And again, you can see this is an uptrend because again, look at this high. There's a high, there's a high, there's a swing high, swing high, swing high, swing high, swing high. So higher highs. And this is a low. This is a low, that's a low, that's a low, that's a low, that's a low, all right? So higher highs and higher lows. And one of the golden rules is you always buy the dip on the uptrend. So what's a dip? So this is a dip, right? Dip, 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 dip. You buy the dip on the uptrend. Let me say, how do you know how low is the dip? I'll talk about it in a short while, right? Because you never know where's the low, right? You want to catch it before it continues its impulsive wave. Now one of the things you never want to do is you never buy the high on the uptrend. Okay, so you never want to buy when it's near the high, right? Because chances are the high is going to retrace back before it goes higher. And again, it's kind of like a breathing pattern, right? The market is like breathing, right? You breathe out, breathe in, breathe in, breathe out, breathe in, breathe out. And when you breathe out, you can't breathe out forever, right? Eventually you got to breathe back in to breathe out again, right? So you never buy on the breathing out because it's going to breathe in, it's going to hit your stop loss. You buy on the breathing in just as it's going to continue. And again, how would you know this? That's why we use candlestick patterns, we use support and resistance, and we use moving averages to kind of anticipate the changes in those points over there. All right. Now, let me share with you a very, very important secret right now. Okay, a very powerful tool right now, which is using moving averages. So different traders prefer to use different moving averages. Now, my favorites are the 18 exponential moving average, the 50 EMA, the 100 EMA, and the 200 moving average. Okay, now again, depending on the strategy, I will use different moving averages as well. All right, so on a certain strategy known as the impulse pullback, I also use the 6 and 18 EMA. But on a different strategy, I'll use a completely different set of moving averages. Right? But in general, I look at the 18, the 50, and the 200. And you can look at 100 as well if you want to. Okay? Now, here's the key. Always remember this. How do you know when a trend is strong? The answer is when the moving averages are in sequence. So, on a strong uptrend, notice that the shorter term moving averages are always above the longer term moving averages. In other words, the 18 is above the 50. Right? This line, the 18 is above the 50 is above the 100, and the 100 is above the 200. When you have got this sequence, boom, you have a strong trend. But when you have the 18 below the 50 or the 50 below the 100, the trend is kind of like, it's not strong. So you only want to trade on a strong trend. And notice that on a strong trend, whenever the price dips, right, breathe in, right, breathe out. Every time the price dips, it will find support at one of the moving averages, depending on the mood of the currency pair on that day or that duration. So you can see in this case, when the price retraces, it finds support at the 18 moving average. Can you see that? It goes bounce, 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 bounce. Now, it's not always the 18 moving average. You must know when different moving averages come in play, and you learn that in the course, okay? But just understand that for this pair at this time, it's finding support at the 18 exponential moving average. Okay, opposite of an uptrend is a downtrend. So on a downtrend, the probability is that prices will move lower. So the golden rule, never buy on a downtrend unless you are suicidal. As long as you keep selling on a downtrend, chances are you're going to make money over time. Okay, because the odds are in your favor. And on a downtrend, do prices go up? Sure, but every time the price goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower, right? It goes up, it goes lower. So it makes a series of lower highs. Okay? Lower highs and a series of lower lows. There you go. So that's the definition of a downtrend. And on a downtrend, you always want to sell or go short on the currency pair. Now, when's the best time to sell? You always sell the rally on the downtrend. So again, what's a rally? A rally is a temporary increase in price. So what happens is it goes up, rally, down, rally, down, rally, down, rally, down. Again, breathing, right? Breathe out, breathe in, breathe out, and it continues. So you always want to sell at the temporary high. That's where you want to sell. So it goes down, you make profits, and you buy back and close your trade, right? Rally, goes down, you sell. Capture the price as it goes down. You never want to sell the low. Okay? Never sell the lows, always sell the rally. That's a golden rule. So again, how do you know it's a strong downtrend? Once again, we put in our moving averages. 18, 50, 100 if you like, and 200 moving average. And again, notice what happens. On a strong downtrend is the opposite sequence. The shorter term moving averages are always below the longer term moving averages. So the 18, which is this red line you can see over there, is below the 50, 50 is below the 100, 100 is below the 200. It is in that sequence. If it's not in sequence, it's crisscrossing, that's not a strong downtrend. Okay? And again, notice that on a downtrend, every time the price retraces or rallies, it finds a resistance at one of the moving averages. So in this case, you can see the 50 is a strong resistance, right? That's a resistance. That's a resistance. That's a resistance. You can see that, right? So boom, hits the 50, comes down. Boom, hits the 50, comes down. Now, does this always happen? Of course not. So many times, price movements are random. They have no patterns. We do not trade those times. We want to trade a time when the price finds a pattern, right? And again, different pairs at different times would respect different moving averages. So you must know when it respects the right moving average to enter. And again, you get the trade alerts as well as you'll learn exactly how to read these patterns in the course. Now, besides knowing the trend, so uptrend buy, downtrend sell, right? But again, if it's on an uptrend, you don't buy if it's facing a supply zone, because you buy, it's going to come down. If you're going to go short on a downtrend, don't sell at a support level, because again, it's going to likely reverse and go in the opposite direction. So you have to be able to learn how to draw these support and resistance levels, or supply and demand zones. So again, it's part of the Piranha Profits Professional Forex Trading course. You're going to learn exactly how to identify these supply and demand zones. And whenever you have got the supply and demand zones coming together, it creates what is known as a consolidation or range period, where the price moves nowhere. It just goes sideways. It's constipated. It can't move. All right. So over here you can see, price goes up, pump, reverses down. Pump, reverses up. Boom, 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 boom. That tells you that at this price level, there are many buyers waiting to buy. It's a strong demand level. Over here, it's a strong supply level. Now eventually, every supply and demand zone will be broken. So when there's enough buyers and they overwhelm the sellers, boom, price moves up. And again, boom, boom, it goes into another zone. And one of my strategies is known as trading the range. So whenever you see the price stuck in a range, we use the trading the range technique, which is you buy near the support and you sell near the resistance. So you buy and sell, wash, rinse, and repeat. And that's a pretty good strategy to make some good money as well. So again, that is part of one of my trading strategies. I've got many trading strategies. One for uptrends, one for downtrends, one for sideways, and one for scalping the news. All right, so when there's a news event, rate news, and the price goes mad, it's a great way to make money. But you have to know when to get in and get out really fast to capture the initial price movement from the news event. Now, there are many ways to trade Forex. Like there are many ways to cook fish, right? You can barbecue, you can steam, you can deep fry, you can eat sashimi. And there's no right or wrong. It depends on what you're comfortable with, all right? I mentioned earlier on that I invest and trade in stocks and Forex. But for the stock market, I tend to take longer term, medium term positions where I hold, like in my investment portfolio, there are some stocks I hold for a couple of months or years. And I also do swing trading for stocks, which means that I hold them for a couple of days. But for Forex, I am a very short-term trader. I tend to be more of a day trader and a scalper. Okay? So a day trader basically means that my trades last within a day. I buy and sell within a day. And most of my trades last for 1, 2, or 3 hours. And I primarily, again, look at the 15-minute candles. And I confirm it with the hourly candles. And each time, I aim to make anywhere from 15 to 40 pips per trade. Right? So that's why I call it piranha trade. It's like a piranha. You're going and take quick bites from that whale. Right? Quick profits every single day. Right? That's day trading. So that's what I do for Forex. Right? I also make a lot of money from scalping the markets. Now, unlike most people, I only scalp during news events, which I'll talk about in a while. For example, there's some GDP news or interest rate news, and sometimes the price can go crazy, can rise 100 pips in a minute. And that's exactly when I get in and I scalp that news and I get out within a few seconds. In fact, usually 60 seconds to 120 seconds. And I use 1-minute candles. And while most people, they target 5 to 10 pips, I don't target 5 to 10 pips. In fact, most of the time when I scalp the news, I'm targeting anywhere from 20 pips to even 100 pips within 60 seconds to a minute. And it makes it a very profitable strategy, in fact. So that's primarily how I trade Forex. I do not really trade Forex as a swing trader. All right, I know there are people who do that. I don't do that because it takes too much time. All right, and people like George Soros, they are position traders, which means that they hold the trade for many months and many years, right? Because they believe in a currency pair in the long run, right? So you can do that, but again, I'm doing it primarily as a trading business, making consistent profits month after month. So the way to do that is day trading and scalping, all right? So when you do that, it takes more speed, you can be fast, it takes more leverage as well, right? So that's my style. If you like it, happy to teach you exactly how to do that. Okay, now, as a short-term trader, to make consistent profits, I always place 3 points in every FX trade. In other words, whenever I enter the markets, I always place 3 orders at the same time. Okay? So if I'm going long, which means I'm, again, bullish, I want to buy and sell higher, buy low and sell high, I would place 3 orders. Okay, so for example, if I want to buy the Euro USD at 3805, because I expect it to go up, right? What do? I will have my buy entry order at 3815. Okay, sorry, I think it's a bit of a typo here. This should be 3815. Okay, 3815, right? Okay. So I put an order to buy at 3815. Now, at the same time, I simultaneously place a stop loss order with my entry order at, for example, 3805. Okay? Why? Because remember that, you can't predict with 100% accuracy, right? There will be times the trade does not go your way, and you must have the discipline to cut your loss and to get out. All right? It's not about being right all the time. It's about being right more than you're wrong. And it's how much you lose when you're wrong and how much you win when you're right that makes you consistent profits. You know, I know people who are able to be right 9 out of 10 times, but they still lose money. Why? Because the one time they are wrong, it wipes out all the profits when they were right. Because they don't have the discipline to get out of a losing trade. They hold on to it and say, it's going to come back, it's going to come back, it's going to come back. I'm right, the market's wrong, and they get wiped out. Okay? I can tell you that you just have to be right 5 out of 10 times to make huge profits in the markets. If, when you're wrong, you lose little, and you are right, you make more than you lose. So the only way to do that is to predetermine your risk in a trade when you enter it. And the way to do that is to place a stop loss. Okay? So if I'm going to buy at 3815, the moment it goes to 3805, I'm out. Trade over, let's move on with my life. Okay? Now, so some of you may ask this question, so how far do I put my stop loss? It depends on the strategy as well as the candlestick patterns, the price action. So sometimes my stop loss will be 10 pips away, sometimes 20 pips away, sometimes my stop loss could be 30 pips away. So it depends on the price pattern, right? The price action. But later I'll teach you that regardless of where you put your stop loss, whether it's 10 pips or 80 pips away, your risk is always the same. Your risk is always constant. Right? You may say, how does that work? Yeah, just hang on. I'm going to show it to you in a short while. Okay? So in this case, I place my stop loss 10 pips away. Okay, because of the price action, right? The candlestick patterns 10 pips away. Now at the same time, I'll place a profit target 15 pips above my entry price. Okay, so in this case, my profit target will be 3830. So my risk is 10 pips. So if I'm wrong, I'm going to lose 10 pips. If I'm right, I'm going to make 15 pips. So 10 pips represents my risk. And I call this R. R is my risk. So my risk distance is 15 pips. So I always make sure that my profit distance is at least 1.5 R above the entry price. So I'm always risking 1 to make 1.5. Now some people say, why don't you risk 1 to make 2 or 1 to make 5? Duh, you think I'm stupid? You think I do not want to do that? Of course I do. But you know what? In the market, there's always a trade-off. Whenever you want to risk 1 to make more, like you want to risk 1 to make 2 or 3 or 4, it's going to be more difficult because the price has much further to go to get there. So your win rate will tend to suffer. So I have found that the sweet spot for short-term trading is 1:1.5. Now there are exceptions. For example, when I scalp the news and there's strong news, sometimes I can risk 1 to make 10. But that's for scalping the news. That's a different technique that I'll teach you as well. All right? But for this technique, which is my normal bread and butter technique, is risking 1 to make 1.5. Okay? Now, so you must calculate the number of lots to buy so that your risk is always constant. And you can risk, for example, 2% of your capital on the trade. All right? Or you can risk 1% or 3%, it's up to you. So if you risk 2% of your capital, then your potential return in a winning trade will be 3%. Right? Because 2% multiplied by 1.5 is 3. So you risk 2% to make 3%. Or you risk 1% to make 1.5%. Or you risk 3% to make 4.5%. You get the drift? Okay? Okay. So how do you calculate the number of lots to buy? So this is the formula. You don't have to memorize the formula, don't worry. No worries, because I will show you how to use an automatic position sizing calculator that does this all for you in 10 seconds. All right? So if you're not good at maths, you don't understand this, it's fine. But I'm just here to explain how it works. All right? So here's how it works. So let's imagine you have got $5,000. That's your capital. Okay? And you decide to risk 2% per trade. 2% on a trade, okay? So 2% times 5,000 is $100, correct? So if you're wrong, it's a losing trade, you lose $100, okay? Now, then you divide this $100 by the stop loss distance. How far is your stop loss? In that case, it was 10 pips, right, in the last example. And you multiply it by the dollar value per pip, which again is about 10 bucks, all right? So you take $100, divide by 100, that gives you one lot. You can just do it yourself. So in other words, you know that you have to trade one lot, you have to buy one lot of the currency pair. Okay, so if you buy one lot with your stop loss at 10, your profit target at 15, what does it mean? That means if you have a losing trade, you would lose $100 because you're risking 2% of your capital. But if you have a winning trade, you would earn 3% of your capital, which is 150 bucks. Make sense? Yeah, so that's how it works, all right? And again, the calculator will do it for you automatically. No worries about that. Let me just look at some questions coming in. Okay, cool. All right. Again, no worries. I'll answer questions in a while. Just hang on. So let me show you an example of a typical trade of mine. Okay. So this strategy that I use is known as the impulse pullback strategy. It's one of my bread and butter techniques that I use every day. Okay. So in this strategy, I'm looking for a new uptrend signal. And again, I use, in this case, the 6 and 18 moving average crossover. So that signals a new uptrend. Okay? And when I get that uptrend signal, what happens is you will see a strong impulsive wave. That means the price goes up because of an uptrend. Right? Now, don't jump in at the uptrend. That's what people do, right? They say, oh, it's going up. Buy. All right? And they buy, what do? They put their stop loss. Let me show you what they do, right? So a lot of people, when they see, hey, there's a moving average, there's a crossover, all right? The price is going up, yes, right? And they start buying here, right? These are where amateurs buy, and they place their stop loss here, right? They put their stop losses here, correct? Now, guess what those bastard market makers do, right? Those big banks and institutions, they will collude with the market makers, and they will push the price down, right? They push the price down, and what happens here? It looks like it's going down, and it hits all these stop losses. So those traders who put the stop losses there, what happens? It gets hit. And in the end, it causes them to sell at a loss. And after it sells, what happens? Boom, the price goes up. Ah! Happens to most people, right? So we don't want to do that. We don't want to be the idiot that buys when everyone's buying and we get hit, our stop loss hit, and the price goes up, right? We don't want to be that idiot, okay? So what I do is I always wait. After I see a strong wave up, I wait for what is known as a pullback, where the price makes lower highs, lower lows, lower highs, and lower lows. Okay, that hits all the stop losses, and I want to see some kind of reversal pattern, right? So in this case, I look at this candlestick pattern known as a bullish pin bar. So this pin bar tells me that the price was pushed down, but rejected by the buyers, right? So the sellers push it down, the buyers rejected it, pushed it back above the moving average. So this is a very, very powerful signal of the bears being rejected by the bulls. And that's exactly when you will enter. You will enter the moment the high of the candle is broken. So the moment you have a new high, you enter. So I entered at this point at 5303. By placing a buy stop order just above the high of this candle at 3503. And I place my stop loss below the lowest low of that pullback wave pattern at 5295. So in this case, I'm risking 8 pips. My stop loss distance is 8 pips in this case. Sometimes it could be 10 pips, sometimes it could be 20 pips. It depends on the candle shape, right? So in this case, 8 pips. So if I'm risking 8 pips, that's 1 R. R is my risk, right? So what's the profit I want to make? I want to make at least 1.5 R. Don't be greedy, be a piranha. So 8 times 1.5 is 12 pips. So 12 plus 5303 is 5315. There we go. So I've got my buy order, my stop loss, and my profit target. Once I enter, it's a fire and forget. I close my eyes, I do something else until I have a winning trade or I have a losing trade. I don't really care because I know I'll win in the end. Or rather, my wins be more than my losses and I'll make money at the end of the day, right? I don't care. So what happens is you can see the next candle it goes up above the high of this candle, it triggers my buy order. So I buy at 5303. After I buy, what happens? It goes up, goes sideways, goes down, goes up, and hits my profit target in about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 candles, which is about 2 hours, right? So 2 hours, I'm out of the trade. I made 1.5 R. Okay, I made 1.5 R. So what is R? R is your risk per trade. So if I'm risking 2%, right, I made 1.5 R, I just made 3% return on my capital. Okay, so in this case, my capital is $5,000. I'm risking 2%, so how many lots do I trade? Again, remember that formula? Well, you don't have to, because again, I'll show you how to use an automated calculator in the trading course, right? Where the calculator will do everything for you. You can be an idiot, no worries, okay? So 5,000 times 2%, divide by 8 pips times $10, right? That's the formula we learned earlier on. That's 1.25 lots. So I know that I have to buy 1.25 lots of this currency to maintain a 2% risk of my 5K capital. So in this winning trade, I make $5,000 times 3%, I make $150. Okay, there we go. That's how it works. Now, what if you're going short? So if you're going short, it's the opposite, right? You're bearish, you see the price coming down, it's a downtrend, you want to go short, same thing, you place 3 orders. So example, Euro USD is at 3805. You expect the euro to continue going down, so you go short at 3805. So when you go short, you're selling at 3805. Selling. Goes down, you make money. Goes up, you lose money, right? So again, we put a stop loss. In this case, my stop loss is 10 pips away. Again, it depends on the shape of the candle. So I'll teach you exactly where to place a stop loss, where to place a profit target in the professional Forex trading course, depending on the strategy and the candlestick setup. All right. So my profit target will always be more than my stop loss, obviously. So if I'm risking 10 pips, that's my risk. Okay, my profit target has to be at least 1.5 times of that. So think of it like a business. In a business, you buy something at $1, you sell it at $1.50, and you make the profit margin. Same thing in the Forex business. Okay, so sometimes you have a losing trade. It's like cost of goods sold. Winning trade, sales revenue. Sales revenue minus cost of goods sold is gross profit. All right, so even if you're right half the time with 1 win and 1 loss, you're making that profit margin. And that's the business of Forex trading. It's not a gambling. It's not being right all the time. It's about having a system. Okay, now I trade a variety of trading systems depending on where the market is. So again, sometimes the market is on an uptrend, it's going sideways, there's news. I use different techniques, okay? So for day trading, I have got 4 main techniques which I use, which are statistically proven to have a high probability to be winning trading system. As long as you keep following the system, you will make money. How do I know? Because I make money. And from historical backtest and forward testing, is proven to be positively statistically significant, right? So I've got an impulse pullback system. That's my favorite go-to every day. I've got the impulse pin bar system, the bounce system, and the trade the range system. So again, you'll be learning these in the Forex trading course. And my most powerful system of them all, scalping the news. Yeah. I'll talk a bit about that later on. This is one of my most powerful systems where I make most of my money scalping the news at least about 8 times a month, right? So this is an example of the impulse pullback system, and it's what I mentioned earlier on, right? When I see the price on an uptrend, okay, first of all, the main trend must be up, right? Remember 18 above 50, 50 above 200, the big trend is up. And then I see a short-term uptrend signal over here. Can you see the crossover over there? Can you see the 2 moving averages crossing? That's right. So this is the what we call the impulsive wave, right? So I never want to buy during the impulsive wave. I always want to wait for a pullback, right? And you can see this is the pullback candle. This red candle pulls back. Can you see the pullback over there? And I'll see some kind of like a reversal pattern, like a bullish pin. So you can see it's a bullish pin. And so once I see that pin, I get ready to buy once the high of that pin buy is exceeded. So my entry price will be placed above the high at 136.87 in this case. My stop loss at 136.78, right below the low of the candle. So in this case, I'm risking 9 pips. So that is the distance of my stop loss. And my profit target is 14 pips over there. All right, so it's always the bracket. So the next candle, it goes up, triggers my buy order. 1, 2, 3. 3 candles, I'm out of the trade, I took my profits, that's it, on to the next trade. So that's about 45 minutes. It's about 45 minutes, right? Let me look at some questions coming in here. Okay. Okay, don't worry guys, I'll answer all the questions. I'm just compiling them right now. So this is the impulse pullback. This is another one, but on a downtrend. So again, you can see the overall trend is going down. And we have got this crossover there. Can you see the moving average crossover there? So again, that is a downtrend signal. That's we call the impulsive wave. Never buy on the down wave. Wait for a pullback. So notice again, it pulls back with a bearish pin bar. That's a reversal pattern, right? So I place my sell order just below the low of this candle at 106.10. I place my stop loss just above the high of that candle. So in this case, my stop loss distance is 15 pips. Why? Because of the length of the candle, right? 15 pips, there we go. So if I'm risking 15 pips, I want to make at least 22 pips, right? Risk 1 to make 1.5. So next candle goes down, triggers my order, goes up, but doesn't hit my stop loss, boom, hits my profit target, and I'm out of the trade, okay? Well, one of the things I tell my traders is once you place a trade, walk away. Close the computer and walk away. Don't stare at the screen because staring at it would not make it go your direction. In fact, you tend to get very emotional when you look at the screen, it's going up, going down, and you tend to intervene. You shift your stop loss, you shift your profit target, and you screw everything up. All right, don't do that. Be mechanical, place it, walk away, find and forget, have a life. Right, go enjoy yourself, go to the beach. That's what I do. Okay, so that is the impulse pullback strategy. This is another strategy known as the bounce strategy. So there are times when the price tends to find a bouncing pattern. It doesn't happen all the time, so you have to wait for the pattern to evolve. So in this case, you can see the pound franc, and it's having this pattern, right? You see, boing, 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 right? So you see that pattern. Now you've got to see that pattern evolve. And now it's coming down, coming down, coming down. Guess what? I have my buy order ready over here. In this case, I use a buy limit order. And I put a stop loss over here below the low of the previous swing low. And my profit target right there. So sure enough, it comes down, hits my buy order, I buy there, boom, hits my profit target, I'm out. This is the bounce system. And again, I'll teach you in the course exactly when it works, when it doesn't work. Right? There are certain patterns you must see in the wave. We call that wave patterns, right? Wave patterns. This is a short example of, again, a downtrend wave. You can see, boom, hits the 50, right? Comes down, goes up again, and we have our sell order waiting there. We have our profit target over there, our stop loss over there. Goes up, fills our sell order, boom, hits our target price, we're out. That's the bounce system. And again, I'll teach you when's the best time to trade the system because you must know when to trade which system. That's the most important thing. Okay, and let me show you my favorite strategy known as the news scalping strategy. Okay, so what happens about 8 times a month, there are some major news being released in the markets. For example, at 9:30 p.m., we have got the dollar Canadian, or rather the Canadian news. They're announcing GDP and unemployment. So when they announce the news, what can happen? suddenly the price can shoot up, shoot down, go nowhere, or shoot up and shoot down, or shoot down, shoot up. Now, you never know what's going to happen. You can't predict the future. But chances are, when the news is not what people expect, the price will move violently. And that's your chance to make a lot of pips in a few seconds, a few minutes. So I'll teach you exactly how to trade this strategy successfully. Okay? And normally what I do is just before the news is released, I'll place both a buy order and a sell order simultaneously. So if the price goes up and triggers my buy order and goes up, what happens? I cancel my sell order, I write the buy order, and I exit in 60 seconds and capturing my profit. If the price goes down and hits my sell order, in this case you can see the price went down, it triggers my sell order and it plunges 58 pips in 1 minute. So it triggers my sell order, I cancel my buy order, and I exit after 1 minute and I capture 58 pips by risking 12 pips. Right, so I risk 12 to make 58. That's risking 1 to make 4.8 R. Right, so in other words, for every 1% you're risking, you're making about 5%. For every 3% you're risking, you make 15%. So it's a very profitable strategy. But you must learn exactly how to trade the technique, because if you don't, it can be quite dangerous. Sometimes the price can go up and go down and hit both your orders and both your stop losses. So you must know how to move fast to avoid things like that. And sometimes the price can get filled far from your intended entry price. You have to know when to exit fast when that happens as well. So I'll teach you and I'll show you a lot of videos, a lot of case studies of live trades that I'm doing, and you're going to learn exactly how to trade this system. All right, guys? All right, let me do a quick time check and see what time it is. All right, okay, we're on time. Pretty good. And here's another one. So in this case, what happened? This was the pound, trading the pound current account. Sorry, was it a pound? No, this is a Canadian again, right? Yeah, GDP, right? So you can see the price was moving sideways. Before the news was released at 8:30, I had my buy order and my sell order placed at the same time. Have no idea where it's going to go. News is released, the price, boom! Whoa, look at that. 46 pips in 1 minute. Triggered my buy order. I took an exit quickly there, and I captured 46 pips, which is about 1.9 R. Okay, so very profitable strategy. You will learn exactly how to do this in the Forex trading course. Okay, now I also will send out trade alerts to alert you of potential trade setups. And once you get the trade alert, it doesn't mean that you place your trade immediately, because these robots that identify trades are not as smart as human beings. So when we have a trade alert, we must still use our eyes to manually see, okay, does it fit the pattern? Is it the right wave pattern? Is it the right candlestick pattern? Then you place the trade. Okay, I'll give you an example. I get many trade alerts every day, but you know what? I only take 1 or 2 trades a day. That's it. Right? And I only take the high quality trades. And I'll teach you exactly which trades to take, which trades to avoid, because you have to look at it. And that's why robot trading never works, because robots, for now at least, are not as smart as humans. Unless, of course, you spend millions of dollars to buy those sophisticated artificial intelligence machines, right? Maybe. But if you're not spending a few $1 million on a trading robot, forget it, it doesn't work. Trust me. Okay, so like I said, in trading, it's a business, okay? And you got to have a business plan. And the business plan goes this way. You have an entry price, a stop loss price, and a profit target, always. Okay? Except for the scalping the news, there's no profit target, it's unlimited profit. And we exit after 1 minute. So that's a different strategy, right? And again, will we have a profitable trade all the time? No, let's be realistic, all right? You can be right 50 to 60% of the time. And you can be wrong 40 to 50% of the time. As long as you follow the trend, you are going to be on the right side of the odds. What's important is when you have a losing trade, you risk 1% of your capital. And if a winning trade, you make 1.5%. Or if you risk 3%, you make 4.5%. So you must always risk, your risk to return ratio must always be 1 to 1.5 or more to get an edge in the markets. And that's the key to it. Trading with discipline. So if you do an average of 20 trades a month, which is what I do on average, I do about 20 trades a month, right? And if you get a 60% win rate, that's 8 losses and 12 wins, all right? And assuming if you risk 3% on each trade, which is what I do, okay? Each loss would be 3%, but each win would be 4.5%, right? Because of your 1.5 hour profit target. So net, you're making 30% return a month at a 60% win rate. Okay, if you have a 50% win rate, right, half the time, and again, that's 10 losses and 10 wins. You're risking 3% per trade for 4.5% return. So you lose 3% when you're wrong, you make 4.5% when you're right, the net profit is still 15% return a month, right? 15% a month compounded, that's more than, almost 200% a year. What more do you want in a business? It's a fantastic business, okay? If your win rate drops to 40%, and it can happen sometimes where you have a low win rate on certain months, like that means there are certain months you can have a 90% win rate, but it doesn't happen every month. There are some months you can get a 40% win rate. So you have so-called lucky months and unlucky months, but if you average it out, 50 to 60% is a pretty realistic win rate over a large sample size, right? So with a 40% win rate, right, it's 12 losses and 8 wins, right? And you are still at least breaking even, okay, at a 40% win rate, all right? So it's almost impossible to lose money unless you do not follow the rules, unless you intervene in the system. You are definitely going to make money over many trades. Not every trade, but over many trades. That's the key to a successful business, all right? So that's how your money can compound at a 12% monthly return. You can see how fast your money can grow. So again, whether you want to create another source of income for yourself to supplement your day job, or you have got savings, you want to grow your savings at a much better return than time deposits in a bank, this is a great way to do it. All right, and just show you a few examples. So that's why I say trading is a perfect business to be in. Again, it's a perfect business because, again, it's flexible. You can do it 24 hours anytime during the day around your day job, work from anywhere in the world. There are no employees to worry about, no rentals, no competitors. The beautiful thing about it is when I teach you how to trade and you make a lot of money, I don't make less money. I make the same money. So we all can profit together. That's the best thing about it, right? It's recession proof. And again, low startup capital. You can start with as little as $200 or $3,000 or $10,000 or $100,000. It's really up to you, right? And it's relatively one of the lowest risk businesses, because if you start a restaurant, for example, and if you lose money in the restaurant, business closes down, you lose everything. But in trading, you only risk a small percentage of your capital. You only risk 3% or 1%. In fact, before you trade with real money, always start by paper trading a demo account to practice for a while. It's like a pilot. Before you fly the plane, you fly in a simulator. So you crash a few times, you make a few mistakes, no one gets hurt. And then you fly the real plane. In no other business can you start a fake restaurant and test it before you start a real restaurant. But you can do it in the Forex trading business, all right? These are students who make 8 to 12% profit per month from Indonesia. You can see, it's about 2,500 profit out of $10,000, right? 12.5% return a month from 5,000. Okay, I've got this guy from Vietnam who said, Adam, I'm now managing a 5 million US portfolio after graduating from Wealth Academy. All right, my boss approved me to manage an FX portfolio investment with 5 million at the bank, right? And I made 3,900 US dollars, covered my fee, right? This was my live training course. Again, if you want to do my live training course, I do it in Singapore, I do it in Asia, in Malaysia as well. If you're far away in South Africa or something like that, in the US, take my online trading course, right? You get the same stuff, right? It's just that, all right, it's online, all right, guys? right? And yeah, when you start to grow your account, right, you can make a pretty good return, right? You can see a 14% return is a 221,000 US dollars in 1 month from a $1.5 million account, right? And 175,000 US dollars profit in a month out of a $1.2 million account. So again, it doesn't matter, how big your account is. $1 million account, a small account. In fact, I had many students say, Adam, your account is really big. How do I know it's going to work in a small account? So what I did recently was I just started a new account with relatively a small amount, just to show people that you can do it for a small account. All right. And I trade with Halifax. By the way, Halifax is my broker. And the reason why I love Halifax is because they are an ECN broker with very, very tight spreads. You can see the spread is very tight, right? The buy and sell is very tight. The spread is very tight. Some brokers, they will mark up the spread, so the spreads are wide, right? I like a broker where, it's a very, very tight spread, and they just charge me a fixed commission, right? And the best part about Halifax is that they're offering my students that if you open an account with them and you fund the account, they'll give you up to 1,700 US dollars of credit into your account. Basically, they're giving you $1,700, which basically means they're paying for your course, right? And now, of course, if you put in your money and they give you $1,700, you can't take it all out tomorrow and go shopping, right? You're not stupid, right? Obviously, you have to trade with the account, but basically, you're getting $1,700 credit, right? So what I did recently was I said, I'm going to pretend to be a student and I'm going to do the same thing, right? So I recently started a new account with them. I already have an old account, but my new account with relatively less money to show people that you can do it with less money, right? And I started it recently. You can see over here that, I got a credit of 1,007. This is from the broker gave me a credit, so that's free money, right? So that brings my equity to 8,400 right now, and you can see that you can see my account history. Right, you can see my total profit so far is for the month is 1,288, 1,200 profit so far. I've still got 1 week left to the month. The month is not over yet, so 1,200 profit out of. Give me a second. Let me just check on some questions here. Give me a sec. Okay, there we go. All right. So sorry, back to this. Yeah. So 1,200 profit in out of a 8,000 account, of which 1,007 is free money. That's about 15% return. All right, 15% return in about 20 days. Right. So I've got 10 more days left. And again, if you take a look at the history, again, right, you have got winning trades and losing trades. Right. So the important thing is when you have a winning trade, it's bigger than your losing trade. Right? There you go, right? So you have your winning trades, losing trades, and as long as your wins exceed your losses, you can see that you will make a very good profit, right? So this is a very small account. It's like little money, but just to show people that, yeah, you get 1,007 of free money, and you get 15%, 20, 30% return a month, right? That's pretty good. That compounds your money pretty fast with very tight spreads. Okay, so like I said, trading is like a business. Now, you know that in a business, less than 10% of businesses succeed, right? Whatever business you start, restaurant or shop, 90% of businesses fail. Why? Well, for all kinds of reasons. The reason is most of the time people have the wrong product. They've got the wrong strategy, wrong marketing, wrong brand, wrong location, right? But when you buy a franchise, like if you buy the McDonald's franchise or Burger King franchise of KFC or whatever franchise, your success rate is not 10%. Your success rate is more than 90%. Why? Of course, you have to work hard to get that success rate. You can't just buy the franchise and not do anything, right? So why does a franchise have a over 90% win rate? Because when you buy a franchise, you're not reinventing the wheel. You're basically buying a proven system, a proven product, proven brand proven marketing. So what I'm giving you is basically a proven franchise system of how to trade Forex. So you don't waste your time making mistakes and learning from your own mistakes and experiences and spend years and years going around in circles, right? Wasting money and wasting time. So how do you start correctly with the right system, with the right training, and have a very, very high chance of success, provided you are willing to work hard. If you're willing to work hard, you are going to succeed. That I can guarantee you. But you got to work hard. You got to treat this seriously as a business. Okay? So let me introduce to you the online professional Forex trading course that's going to be available for you in this webinar at a really special tuition fee, right? So the Forex trading course takes you from beginner to really, really powerful day trader. And I've got an advanced Forex trading course that lets you scale your profits in any market condition by mastering these advanced day trading strategies and scalping techniques, right? So I've got a basic course and the advanced course. And again, whether you're a beginner, you've never traded before, you've got no idea how to trade, or you are someone trading for years, this is for you. This is for you to succeed. Okay? So, oh, by the way, a trade alert just came in as you saw, right? Pound Aussie yen, right? So I'm going to finish this webinar and go trade in a while, right? Okay, so let me finish off, right? So this is the website piranhaprofits.com, all right? You can see my Forex trading course is there, and you can purchase it at the website. But hold on, we've got a special promotion for you guys today. All right, first of all, the curriculum. So in the professional Forex trading course, you will have altogether 8 lessons, all right? 8 lessons. So the first lesson is an introduction to Forex trading. You learn exactly how the business works, what's Forex all about, and again, how to profit from Forex moves in the market. We covered more or less a lot of the basics in the webinar. I'll go a bit deeper in the course itself. In lesson 2, you will learn the secret to achieving consistent trading profits. How to trade like a casino. So that as a trader, it's like you're running your own mini casino, because a casino always wins in the end. The house always wins because they fix the games so that the games have an edge to the casino, just like you're going to have an edge as a professional Forex trader. Lesson 3, you'll be learning how to master technical analysis. You learn all the things like candlestick patterns, how to identify trends, how to read support and resistance levels, how to master moving averages, and how to use the trading platform called the MT4 platform, right? How do you click buy, how do you click sell, how do you set your stop loss, your profit targets, how do you do everything? It's going to be really hands-on, step by step. Lesson 4, you're going to go and learn about position sizing again, how to calculate the number of lots to buy. You learn how to automate your trading business so you don't have to be there, all right, and stare at the screen, right? Everything is done automatically for you, buying, selling, and so on and so forth. So it's a fire and forget system. In lesson 5, you learn the impulse pullback strategy, one of my bread and butter strategies that I trade every day. You learn the exact entry and exit rules, how to filter for high quality trades, and you also will get all the trade alerts, all right? And how to manage your trade once you're in the trade. Lesson 6, really important, all about the psychology of winning traders, how to think like a winning trader, how to manage your emotions, okay, how to manage temporary drawdowns, and how do you program your mind to be a winning trader using NLP, neuro-linguistic programming, which is a very powerful tool that I use to trade optimally every single day. In lesson 7, you will learn the impulse pin bar strategy, which is another very powerful day trading technique. Again, you learn about the candlestick patterns behind it, when to enter, when to exit, how to filter for high quality setups. Finally, in lesson 8, how do you develop a Forex trading plan? I'll be giving you a trading journal to follow every single day, how to choose the right Forex broker for you, and again, how do you get that special education bonus credit in your account? And how do you develop a winning trading plan? Okay, then we go on to the advanced Forex trading course. This is where you learn advanced technical analysis, For example, Fibonacci ratios. How do you use Fibonacci in looking at retracements and extensions in the market? You learn about the power of confluence to achieve high probability trades, the importance of multiple time frame alignments, and you learn about, again, how do you master supply and demand zones that create a trading edge in the markets. You learn the moving average bounce strategy, which I talked about just now. How do you identify a bouncing pattern? How do you trade it on the long and the short side? This will give you a risk to return ratio of 1:2 for this strategy, and you get 10 to 15 trades a month on average. You can trade this on any currency pair. Again, it works on both long and short setups, and this is a very powerful technique to trade when markets are in a strong uptrend and a strong downtrend. Again, there are going to be a lot of live trading examples in action. You'll be learning about how to manage the trade once you're in the trade, how do you filter for high quality setups, and how do you read the highest probability wave patterns. And drum roll, most powerful strategy you'll be learning in the advanced course is my news scalping strategy. How do you get in and out within 60 to 90 seconds and make huge consistent profits every single month. All right, so whether the market goes up, goes down, goes sideways, you learn how to manage the trade. All right, achieve massive profits in seconds by scalping market moving news. All right, again, a lot of live trading examples in action, so you know exactly how to react in every situation. Okay, I hope you're excited, because I am really excited just to teach you this stuff. So again, you know, market goes down, we can make huge profits, or if the market goes up. And then in lesson 4, you will learn that when the market is in a sideways pattern, in a range, how do you trade the range, right? By buying at support, selling at resistance, and wash, rinse, and repeat. Again, this is another very useful pattern to know when price is going sideways. So a strategy that takes multiple profits when currency prices trade in a range. Again, a lot of live trading examples, when to enter, when to exit, how do you manage your trade, and so on and so forth, right? Okay, so here's what you get, guys. For the Forex trading course level 1, it's usually priced at 1288 US dollars. And I can tell you that it's the best investment you can make, because you're going to make many multiples of that in the years to come. Okay? Many people, they go to the university, college. How much do they spend? They spend $50, $80, $100,000 on a college education university to learn a skill like engineering or accounting, to get a job, to work 9 to 10 hours a day to get a salary, right? That can't even guarantee you a job in 5 to 10 years, because you can get replaced by someone else, younger, cheaper, or faster, or get replaced by a robot. But you know what? For just 1288, investing in yourself, you have a lifelong skill. It's going to help you to generate income for the rest of your life. That's recession-proof, that no one can take this skill away from you. For the advanced Forex course, it's 3688. All right? And again, that is something that you can make back within a month or two really fast when you apply the systems. Okay? Plus, you get a bonus of 12 months Forex setup alerts worth 588. So the total value of what you're going to get is 5564. You're not going to believe this, but for this webinar, because you're listening to me, you're going to get this entire full Forex course, level 1, level 2, advanced Forex trading alerts for just 1,600 US dollars when you enroll right now. So the lines are open. Click the subscribe button, click the enrollment button, get in right now, grab this, while places are still there, because we're going to close it really fast. I'm going to answer some questions. After the questions are answered, it's closed. So grab it right now. Grab your credit card, grab your pen, go do it. Okay, now here's the exciting thing, right? If you open an account with Halifax Brokers, and Halifax is based in Australia, okay, so again, I use them personally because they've got the best spreads, they've got the lowest commissions I can find, so it really helps me as a broker. So I'd like to share this with you. Now, for this exclusive webinar, if you are not from the USA, okay, if you're outside the US, you're in Singapore, you're in Philippines, you're in Africa, wherever you are, not in the US, if you deposit $3,600 in the account, you will get a bonus, okay, of 1788 in terms of trading credits. All right, 1788. So you're getting 1788, which basically pays for your entire cost. So the broker is paying for your cost plus more. Okay, now usually you have to fund 7,500 to get 1788, but only for this webinar, you just have to fund 3,600 money, cash, to get 1788 in trading credit. Of course, terms and conditions apply. You can't take out all the money immediately. You have to trade with them over a certain period of time. Now, if you are from the US, because of regulatory requirements, you have to deposit 18,000 US dollars to get 1788 trading credits if you're in the US. But if you're outside the US, again, 3,006. All right, guys? So you got to grab this because this is an opportunity that won't be here for very long, right? So grab it right now, and it'll be open for the next few minutes, I think 5 or 10 minutes, as you grab your credit card, whatever, go grab it, right? So let me answer a few questions right now while some of you are grabbing this offer while it lasts. Okay, question again, people ask. Adam, how long can I view your videos for, right? It's unlimited. Once you get access to the videos, you can watch it for a lifetime, right? As long as the internet exists. So there's no limit. Take your time to learn it, right? Okay, Adam, if you've got questions, what support do you provide, right? We provide unlimited support for all questions. So anytime, ask us questions, right? Email to us. We respond really quickly to any question you have. Our job is to make sure that you can apply what you learn, you can succeed, and you can even send screenshots of your trades for us to review your screenshots and send us your trading journals. My team will be happy to assist you to look at your trades as well with no extra charge. We're happy to help you to do that, right, guys? How long does a trade last? How many trades do you do, right? Personally, I do about 20 plus trades a month, all right? On average, 20 trades a month. And my scalping trade lasts, again, 60 seconds to 2 minutes. And my impulse pullback setups or bounce setups last for about an hour to 2 hours. Yeah, so I normally take about 1 or 2 trades a day maximum and 20 trades a month. Let me say, but that doesn't add up. If you take 2 trades a day, that's more than 20 a month. Yeah, because I don't take a trade every day. Because not every day do you have a trade to take. Some days there are no good trades, I don't take any trades. So we only take good trades. We don't force and take trades that are of low quality. Okay. How much am I expected to earn? Okay. Now, on average, I can tell you that you can realistically achieve about at least 4 to 5 hours a month. At least 4 to 5 hours a month on average. Okay. So again, on good months, you may get 10 hours. On certain months, you may only get 1 hour. And you may have negative months. It is possible to have a negative month. On average, 4 to 5 hours a month is pretty achievable. So what does 4 to 5 hours mean? Remember, if you're risking 3%, 1 hour is 3%, 5 hours is 15% return. So what I mean is 15% a month to even 20% a month, right? If you get 5 to 6 hours, a month. Okay. Which country can I be in to enroll? Now, this is open to all countries except Singapore. I'm sorry, right? Because in Singapore, I run my live trading program. So if you're Singaporean, you can't apply for this. If you apply and you pay, we're going to refund you all your money. We're going to take your money, right? Because for Singapore, you have to attend the live program which I run, and the online is only for people outside of Singapore, right? So again, South Africa, no problem. Brazil, Australia, the UK, the US, sure, you can enroll for this, right? Adam, do you use Bollinger Bands and Elliott Waves? No, I don't, right? There are so many techniques that you can use, and they all work, but you must know when to use them. And I don't use them for Forex. I use my own systems that work really well. So I don't use Elliott Wave and Bollinger Bands for Forex, okay? Okay, Adam, in your scalping, you were mentioning that do you have a target price? Like I said, I don't have a target price when I'm scalping the news, because once the news is released, I enter and I exit exactly in 1 minute. Or rather, I raise my stop loss to the current market price in 1 minute. So if the price continues going in my favor, I keep raising my stop loss until I get stopped out. So sometimes it can keep running and I can keep making more and more until my stop loss is hit. Right? So there's no fixed target price for scalping the news, but for all other strategies, I do have a fixed target price. Okay. For example, for the bounce strategy, right, my target price is 2 to 1. So I'm risking 1 to make 2. For the impulse pullback strategy, I'm risking 1 to make 1.5. So it depends on the technique, depends on the setup. Very, very important. What time frames do you trade? Like I mentioned, I trade on the 15-minute time frames primarily. And I always double check the hourly time frame so there's alignment in multiple time frames. When I scalp the news, I scalp with the 1-minute candles. All right, great. So these are some of the key questions coming in. And again, quick reminder, for this webinar exclusive, you get the full Forex course, all right, worth 5564. You get everything for 1,600 right now, right? So click enroll as fast as you can. Learn this stuff, guys, because you know what? I can tell you this, the next recession is coming. The whole economy is going to crash. I don't know when. It's going to be in the next few years. So learn this recession-proof skill. So if, God forbid, if you lose your job, you lose your income, at least you have another income for yourself. But you need time to master this new professional skill. So learn this as early as you can. Okay, and again, not only that, but when you open an account with Halifax Brokers and you fund your account with 3,600 US dollars, as long as you're not from the US, you get 1788 in trading credits. That's credit to your account. It's your money. It basically pays for your course. You're getting a free course, all right, essentially. If from the US, you have to put in 18 grand to get that bonus. All right, guys? All right? Okay, so if you got any more questions, right, feel free to send us an email. Our team will be happy to help you. We're going to keep the lines open for the next 5 or 10 minutes. For some of you, I know you're still enrolling. Don't worry, we'll hold it for you for the next few minutes for you to enroll. Let's see what's the time right now. Yeah, okay, we'll give it a few more minutes, yeah. And let me see the next questions. Adam, which pairs do you trade? Oh, I trade all the pairs. In the 8 major currencies, like I mentioned, Euro, US, Yen, right, Franc, Aussie, Canadian. What am I missing? Swiss franc. I mentioned Swiss franc, right? Yeah, 8 major currency pairs. I trade all the crosses, right? And again, it depends on the trade alerts. Whenever the trade alert comes, if I'm awake, if I'm not doing anything kinky, I'll trade. If I miss it, it's fine, right? So you miss certain trades, it's fine, and you take the trades which you can take when you are free. And again, you can trade around your day job, 24 hours a day, right? So it's up to you. Okay. All right, guys. So I'm going to leave you right now and keep the lines open for the next few minutes for you to enroll. So with that, I thank you for listening to this. I hope it's been useful. I look forward to seeing you in the program, and I wish you all the very best to support you all the way to become a professional Forex trader. It's Adam Koo. May the markets be with you always.